Welcome back to The Deep Dive, where we take your stack of sources and extract the most important nuggets of knowledge to help you become well-informed fast. Today, we're doing a deep dive into an investment analysis report on a company often compared to a legendary compounding machine. The Markel Group, NYSE ticker MKL. We've received a fascinating and enduring business quality analysis memo prepared for an investment committee. And our mission today is really to unpack this detailed look at Markel's business, its competitive advantages, and its financial health. The core question we're exploring for you is this. Is Markel Group truly a baby Berkshire, poised for decades of compounding? Or are there underlying challenges that perhaps make it more of a value trap for the unwary investor? We'll explore why some see it as an attractive long-term opportunity, while others remain pretty cautious, giving you hopefully a comprehensive understanding of what's truly going on here.
That's a massive question. And before we dive right into the details, maybe just a quick note for our listeners.
Good idea. Yeah. For those who want to, act on these investing ideas, having a professional grade platform is really key. We use Interactive Brokers, and actually we've partnered with them to get our viewers a stock bonus when they sign up.
Oh, nice. So they get a bonus and support the channel at the same time. That link is in the description below, right?
That's right, yeah. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and, to get the next one is to subscribe and like the video. It truly helps the channel grow. And hey, if you have any questions regarding the company, please manifest yourself in the comment section. We do read them.
Perfect. Okay, now let's really get into it. That first pillar you mentioned, the business model.
Yeah.
How does Markel actually operate?
Okay, yeah, let's unpack Markel's foundational business model. The report describes Markel as operating this three-engine system.
Mm-hmm.
It's designed for long-term compounding, and it's a setup that frequently draws those comparisons to a smaller, maybe more agile version of Berkshire Hathaway.
What's truly ingenious here, I think, is how these three engines are designed to be interdependent. They create this powerful, almost self-reinforcing, virtuous cycle. The first engine is their insurance business. This is really the foundational core, going all the way back to 1930. Markel specializes in underwriting property and casualty, or P&C, insurance. But not just any P&C, it's for niche, complex, often hard-to-place risks.
Right, so we're not talking about your standard car insurance here.
Exactly. Think beyond that. We're talking coverage for things like horse farms, summer camps, marine shipping, or, highly valuable fine art collections, stuff that needs special handling. The goal from this first engine is pretty straightforward. Generate underwriting profit. That just means they aim to collect more in premiums than they eventually pay out in claims and all their operating expenses. The report points to a combined ratio of 95.2% in 2024, which clearly indicates they were profitable on the underwriting side.
And that's an improvement from the year before, right?
It is, yeah. An improvement from 98.4% in 2023. But beyond just that profit, there's something else crucial happening here. Because premiums are collected up front, but the claims get paid out over time, sometimes a long time. This whole process generates a substantial pool of capital that costs them very little. We call that insurance float.
Ah, the famous float.
The famous float. And that float can then be intelligently invested, which leads us directly to the second engine, engine 2, investments. This engine takes that low-cost float along with Markel's own shareholder capital and invests it. Their portfolio is primarily fixed income, bonds and public equities, and it's managed with a decidedly long-term, value-oriented philosophy.
Very much in that Berkshire mold, then.
Very much so. In 2024, this investment engine was actually a huge contributor. It produced $913 million in net investment income and, get this, $1.8 billion in net investment gains.
Wow, okay. Significant.
Very significant. And finally, we have engine 3, Markel Ventures. This segment was established back in 2005. It acquires controlling interests in a really diverse portfolio of high-quality non-insurance businesses. Their philosophy here is permanent capital. That means they buy these businesses with the intention of holding them, forever.
So they're not looking to flip them?
Not at all. We're talking about companies like Brahmin. They make luxury handbags. Costa Farms, a big grower of houseplants. Cottrell, which manufactures car haulers, and also the Markel Food Group, specializing in bakery equipment. It's a real mix. In 2024, this segment generated $520 million in operating income.
So if we look at those three engines working together, the insurance providing the float, the investments growing it, and ventures adding another stream of earnings, what does this all mean for you as an investor? Does this setup give Markel a unique advantage? Is it like building a financial fortress from its own cash flow, making it sort of a self-funding machine?
Precisely. I think that's a great way to put it. It translates into a remarkably straightforward and importantly durable business model. The fundamental need for specialized insurance. That's pretty much permanent. And the diversification you get from Markel Ventures adds incredible resilience and stability. It makes this three-engine system highly likely to remain relevant and profitable for, well, decades to come.
Built for the long haul.
It's designed for endurance, absolutely, not just chasing short-term wins.
Okay, so every great enduring company needs that competitive fortress, the economic moat, to protect its profits. The report identifies Markel's main moat as intangible assets, specifically specialized underwriting expertise. How formidable is that moat, really? Is it deep and wide?
Well, this expertise has been built up over 90 plus years now. They started insuring jitney buses back in 1930. And from that foundation, they've built this truly formidable knowledge base and brand reputation for accurately pricing complex, unusual risks. Like the example you mentioned earlier, insuring a high-value thoroughbred racehorse. That isn't about standard actuarial tables. It requires a really sophisticated understanding of bloodlines, veterinary science, market values, even the horse's temperament sometimes.
Stuff a generalist insurer just wouldn't have a clue about.
Exactly. They couldn't replicate it easily. This deep knowledge allows Markel to operate profitably in these niches where competition is naturally limited. It actively kind of repels those generalist competitors.
Okay, but here's where it gets, as the report says, really interesting.
Sure.
Because it highlights a critical asterisk regarding this moat's trajectory. You said it allows them to operate profitably, but is that consistently translating into superior profits compared to peers? Is the red team maybe challenging that assumption?
That's a crucial point, and yet the report digs into this. While the core market they operate in, the excess and surplus lines, or E&S, is growing rapidly. And just to clarify for you, E&S lines are basically the market for unusual, complex, or harder to insure risks. Things standard insurers often avoid.
Like insuring a giant construction project or a unique event.
Exactly. Or certain professional liabilities. And that market has ballooned, right? From about 5% to now over 9% of the total U.S. P&C market. Markel's a strong number 4 player there. However, and this is the big however, the effectiveness of its moat in consistently generating truly superior profits has been challenged recently.
How so? What's the evidence?
The report explicitly compares Markel's 5-year average combined ratio, which is 94.7%. Remember, lower is better for combined ratios. It compares that to more focused E&S peers like Kinsale, which boasts an impressive 78.7% average over that same period.
Wow, that's a huge difference.
It is. And RLI is another strong peer at 87.2%. So, yeah, that signals a significant profitability gap between Markel and some of the best operators in their space. Management hasn't ignored this. They've publicly acknowledged the discrepancy. They initiated a board-led review, made operational changes, even exited some unprofitable lines of business to try and address it.
So the moat exists, the specialized knowledge is there, but its power to generate best-in-class returns seems to be under pressure, being actively tested and maybe rebuilt.
That's a very good way to put it. Tested and rebuilt. Which logically leads us to how customers and employees actually perceive the company day to day.
Yeah, if their moat relies on specialized underwriting expertise, but the claims process, which is the ultimate delivery of that expertise, breaks down. Okay. How does that fundamentally undermine their competitive advantage? It's got to be more than just eroding trust, right?
That's a really penetrating question. And the customer perspective, according to the report, it really presents this tale of two customers. It's quite stark. On one hand, Markel is incredibly well regarded at the commercial and wholesale broker level. These are their direct B2B relationships. Their top 5 independent brokers account for like 38% of their gross written premiums. That points to deep, trusting, long-term relationships. That's crucial for a specialty insurer.
Okay, so the brokers who place the business like them.
Exactly. But then on the other hand, you look at the public review platforms, the ones that capture the experience of the end policyholders, the actual customers getting the coverage, and they tell a remarkably different and frankly concerning story. On ClearSurance, for instance, a striking 53% of reviews are rated poor.
Ouch. Over half.
Over half, yeah. And the Better Business Bureau data apparently shows a consistent pattern of complaints. Things like frustrating communication, really convoluted claims, handling processes, billing errors. And this isn't just random online noise. It's corroborated by anecdotal evidence from insurance professionals themselves. One adjuster was quoted saying Markel's claims department performance had recently declined from average to awful.
Awful. That's strong language. It directly impacts the perceived quality of that specialized expertise, doesn't it?
It absolutely does. It paints a picture of a clear operational problem, particularly within that claims division.
So for you, the end customer, that claims experience is everything. It's the moment of truth. And a poor one can definitely erode trust in that brand equity, maybe making the moat feel less impenetrable over time.
Completely agree. But then conversely, you look inside the company. Employee sentiment seems overwhelmingly positive, remarkably aligned with the Markel style.
That's their official creed, right, from the 80s.
Yeah, written back in 1986. It emphasizes things like excellence, honesty, a long-term perspective. And the data supports this. Comparably, data showed 100% positive reviews out of 32 employees surveyed. They praised the culture, the leadership. This strong internal foundation is a critical asset, really. It provides stability and hopefully a unified force to address those external challenges, like the operational issues and claims.
Like a stable core to fix the outer layers.
It suggests a deep sense of ownership and shared mission inside the company, which is, quite valuable.
Okay, let's shift to the people guiding this ship. Tom Gayner. He became sole CEO in 2023 after being co-CEO for a while. The report highlights him as a key steward of Markel's culture and, crucially, its capital. What defines his approach? Why is he seen as so central to the Markel story?
Well, his philosophy is profoundly long-term and very owner-oriented. It's almost the antithesis to the short-term pressures you often see from Wall Street. He often compares Markel to a redwood tree, symbolizing enduring growth over centuries, not just quarters. He frames annual results as just rings in this much larger entity.
I like that analogy.
It's powerful, isn't it? And he also talks about a win-win-win outcome. For customers, for associates, their employees, and for shareholders. And the report suggests this isn't just rhetoric. It genuinely drives a focus on building durable, lasting value. He views Markel, and I love this quote, as an infinite, self-reinforcing, and enjoyable game.
An infinite game, that definitely implies a long-term perspective.
Absolutely, which is exactly what you want in capital allocation.
Right. Speaking of capital allocation, the report details Markel's track record here. How do they actually deploy capital? What does that tell us about their financial discipline?
They seem to have a very rational, very shareholder-friendly approach. It breaks down into three main avenues. First, there's reinvestment in the core business. We already talked about the strategic review and the new CEO they brought in for the insurance division. That shows a clear willingness to confront problems head-on and put capital back into the core where it's most needed to improve profitability.
Okay, fixing the engine.
Fixing the engine. Then there are acquisitions, particularly within Markel Ventures. They follow that patient, permanent capital approach. They acquire profitable businesses, often using equity, and they truly intend to hold them forever, integrating them into the Markel family, not just flipping them for a quick buck. The recent agreement to acquire the MECO Group, that's a specialist marine MGA, managing general agent.
Right, like an intermediary underwriter.
Exactly. That seems like a logical bolt-on addition. It strengthens their core insurance footprint in a valuable niche market, marine insurance. And finally, there's shareholder returns. Now, Markel doesn't pay a dividend.
No dividend, okay.
But they have a highly disciplined and value-oriented share repurchase program. Management uses this internal framework they call orange and blue to estimate their own intrinsic value.
The true underlying worth of the business.
Precisely. And they're a willing buyer of their own stock when the market price offers a significant discount to that internal estimate. They bought back $573 million worth in 2024, and they have a new $2 billion authorization in place now. That signals a strong commitment to returning capital this way when it makes sense.
And the report mentioned something about shareholder turnover.
Yeah, that was fascinating. It noted Markel's shareholder base has one of the lowest turnover rates in the entire market, apparently second only to Berkshire Hathaway itself.
Wow. That speaks volumes about investor alignment, doesn't it? Long-term holders.
It really does suggest investors buy into that long-term vision.
So this paints a clear picture of rational capital allocation. These decisions, combined with their business model, they lead to what the report calls a fortress balance sheet. But how do we reconcile that clear financial strength with those earlier concerns we discussed about the core insurance profitability? Does one truly offset the other for you as a long-term investor?
That's really the crux of the matter, isn't it? For you as an investor trying to weigh this up, if we connect this to the bigger picture, Markel is fundamentally a reliable operating earnings machine. Now, Consolidated net income, the bottom line number you see reported that can swing wildly. That's because of GAAP rules, the accounting standards. They require Markel to report unrealized investment gains and losses, paper profits or losses on their equity portfolio that haven't actually been cashed in yet.
So market fluctuations drive big swings in reported profit.
Exactly. Like that $3.7 billion profit reported in 2024 versus a $93 million loss in 2022. That reflects market movements mostly, not a fundamental breakdown in the actual operations. The underlying insurance and Markel Ventures engines are consistently profitable. A long-term investor really has to look through that accounting noise.
That makes sense. So let's dig into some of the key quality ratios the report highlights. What do they tell us about Markel's financial health beyond those noisy headline numbers?
Okay, yeah. We see their return on invested capital, ROIC, was pretty healthy at 13.5% in 2024. That indicates strong value creation, and it bounced back robustly after those investment losses hit the denominator in 2022. Their net debt EBITDA ratio, consistently low, very conservative. It was approximately 0.6x in 2024. That unequivocally signals that fortress balance sheet we mentioned, loss of safety margin there.
Very little debt relative to earnings power.
Exactly. And then the combined ratio. As we discussed, it has consistently been below 100%, which means they are making an underwriting profit overall, but, and it's the recurring but, it's notably higher than those best-in-class peers.
Yeah.
Improving this, getting that ratio down closer to the Kinsales and RLI of the world, that is indeed the single most significant area for operational improvement. It's the primary lever for accelerating future value creation.
Okay, so given all of this, the strong model, the great allocator, the fortress balance sheet, but also the lagging profitability and customer service issues, what does it all mean for you and that critical price to value question? The report notes Markel trades at a PE, price to earnings, of about 14.7x and a PFCF, price to free cash flow, around 12.0x as of mid-2025. Does Wall Street have it right with its sort of lukewarm hold consensus, or is there an opportunity here?
Well, the crucial judgment in this analysis is that, yes, despite Wall Street's seemingly meh hold consensus, the current stock price actually appears to be an attractive entry point, but specifically for a truly long-term investor. And this conclusion is based on three core factors.
Okay, what are they?
First, there seems to be a significant discount to management's own intrinsic value estimate. Management who, let's face it, knows the business best and has proven to be owner-focused, they estimate that true underlying value at approximately $2,610 per share. The stock, last I checked, was trading closer to $2,000. That's a material discount, roughly 23%.
Okay, management thinks it's worth considerably more.
Considerably more. Second, there appears to be market myopia. The market seems overly focused on that lagging combined ratio and maybe spooked by the short-term GAAP earnings volatility we talked about. And in doing so, it might be undercrediting the underlying strength of the operating businesses and the proven quality of Gayner and the management team. And third, there's potentially asymmetric upside. Think about it. If they do successfully turn around that underwriting profitability,
Getting the combined ratio down.
right, that wouldn't just lead to increased earnings directly, it could also trigger a higher valuation multiple. The market might say, Markel is a top-tier insurer after all, and be willing to pay more for each dollar of their earnings, effectively re-rating the stock upwards. This creates the potential for a double-barreled return for investors who buy in while the market is still skeptical.
Interesting. Increased earnings and a higher multiple applied to those earnings.
Exactly. That's the potential payoff.
So looking ahead, the primary growth engine seems pretty clear then. It's the successful execution of that compounding flywheel we talked about, really catalyzed by improving profitability in the insurance engine.
Yeah.
It all comes back to lowering that combined ratio. What's the strategic embodiment of this growth plan? Do they have a target?
They do. The report highlights management's ambitious but seemingly achievable 10-5-1 goal.
10-5-1.
Yeah. $10 billion in annual earned premiums within 5 years, while simultaneously generating $1 billion in annual underwriting profit. That's the strategic target that encapsulates their growth plan. A more profitable insurance operation generates more underwriting profit, obviously, but it also grows that low-cost float base more quickly.
Which then feeds the other two engines.
Precisely. It feeds the investment engine and potentially provides more capital for ventures acquisitions, accelerating the whole flywheel.
Makes sense. But of course, no investment comes without risks. The report identifies several genuine long-term risks that could lead to, permanent impairment of value. What are those critical considerations for you to keep in mind if you're looking at Markel?
Yeah, this is really important. The report pinpoints 3 genuine long-term risks. The most significant, the one that keeps coming up, is the failure to meaningfully improve underwriting profitability. If that profitability gap we discussed turns out to be structural, maybe something fundamentally unfixable because of market changes or deep-seated internal inefficiencies, then the core engine just remains inefficient. That would lead to slower growth and probably mediocre long-term returns, validating the current market skepticism. This is the primary concern for the red team scenario.
So risk number one is basically, what if they can't fix the insurance engine?
Exactly. Risk number two. As an insurer, they are inherently exposed to a large-scale catastrophe, what the industry calls a supercat. This refers to those unpredictable, really severe events, think massive hurricanes like Katrina or Ian, widespread cyber attacks, crippling infrastructure, maybe even pandemics. While they manage this risk through diversification and buying reinsurance, an unprecedented single event, or maybe a series of quick, severe catastrophes hitting close together, could significantly impair their capital base.
The big one you can't predict.
The big one. And finally, there's always the risk of a major capital allocation error. Tom Gayner has a great record, but nobody's perfect. A truly value-destructive acquisition within Markel Ventures, paying way too much for something, or perhaps a significant strategic misstep in the investment portfolio, could severely damage shareholder value.
Right. Even the best make mistakes sometimes.
It's always a possibility.
Okay, so finally, let's zoom out again and consider the second-level thinking the report encourages. How does this comprehensive analysis diverge from what seems to be the prevailing market consensus? Where's the edge, potentially?
Well, the prevailing market narrative about Markel, as we've touched on, is kind of, it's a baby Berkshire, great culture, brilliant capital allocator in Tom Gayner, but it's fundamentally weighed down by this subpar insurance operation that hasn't fully capitalized on the recent favorable market conditions, the hard market. And this view leads to that, lukewarm hold consensus rating we keep mentioning.
Okay, that's the street view.
That's the street view. However, the analysis we're discussing arrives at a significantly different conclusion. It argues the market is underestimating both the probability and the potential magnitude of a successful operational turnaround in that insurance engine. The consensus seems to see a chronic, maybe unfixable condition, like Markel just is a less profitable underwriter. But the evidence presented management's proactive steps, the internal cultural strength, the financial fortitude, it points more towards an acute problem, something that is being vigorously addressed and from a position of exceptional strength.
So the market sees a permanent limp, while this analysis sees a treatable injury.
That's a great analogy, yes. The analysis suggests the market appears to be mispricing the company's potential for significantly improved profitability and that subsequent re-rating of its valuation multiple we talked about.
So for you, the listener, the report offers this pivotal red team challenge. What if that moat of specialty expertise is more brittle than it appears today? What if the underwriting underperformance isn't just a temporary operational blip, but actually a permanent structural issue? Maybe nimble, data-driven competitors have truly eroded Markel's historical edge, and the market's current skepticism is, in fact, completely justified. That's the bear case, right?
That is absolutely the core bear case to wrestle with.
Well, this has been a truly illuminating deep dive into the Markel Group. We've certainly seen a company with a powerful, long-term compounding model, a clearly exceptional stewardship under Gayner, and that fortress balance sheet. Yet it's also facing these critical operational challenges, particularly in its core insurance business, that demand very careful scrutiny from any potential investor. The report we've unpacked ultimately suggests Markel represents an attractive entry point for patient, long-term investors, primarily due to its discount to management's view of intrinsic value and the significant potential for a successful turnaround in its insurance operations.
But as we explored throughout, the biggest risk, that core red team challenge, it absolutely remains. What if that underwriting profitability gap isn't fixable? What if it is, in fact, a symptom of a deeper structural issue that management can't overcome?
So for you, the listener, the ultimate question seems to be, given Markel's demonstrably strong culture, its committed leadership under Tom Gayner, and their very public stated intention to fix insurance profitability, how much faith should you place in management's ability to truly close that profitability gap with its best-in-class peers? And what would a successful or maybe unsuccessful turnaround really mean for that enduring baby Berkshire comparison going forward? What will you be watching for next as the story of Markel Group continues to unfold?